to today's episode of Heard and Seen Around. I'm Rajesh Karipurat, and this is a collection of things that I find interesting from India and from around the world. Things which I believe will have an impact on the economy, currencies, interest rates, and such in the days ahead. I hope you enjoy watching it as much as I enjoyed curating it. Thank you. Investment trade often means buying gold, commodities, inflation linked bonds, or even cryptos, assets seen as stores of value. When what's driving this? Geopolitical and policy uncertainty, persistent inflation concerns, debt debasement from high deficits, and risk to the Fed's independence. A weakening confidence in fiat currencies. Diversification away from the US dollar. Why are we talking about this? The gold is trading at around $3,900. In fact, it's trading above $3,900, poised to set yet another record high, and Bitcoin is within 1% of its all time high. Since 2021, both UK and US 10-year government bond yields have surged, tracking global inflation and central bank tightening. But the UK gilt yield has stayed consistently above its US counterpart. During the 2022 market turmoil, dubbed as the Liz Truss moment, UK yields spiked sharply amid the mini budget crisis, peaking at nearly 5%, above 5% actually. Though they've eased since, the spread over US treasuries, shown below in green, remains positive again by about 60 basis points today. Alibaba's valuation is finally normalizing. After years of compression, the company's forward price to earnings ratio has climbed back to its long term average. Following the 2021 regulatory crackdown, Alibaba's multiples collapsed below 10 times earnings, a level last seen during its early IPO years. Now, with sentiment improving and earnings stabilizing, its forward PE has now rebounded to around 21. This reversion to the mean suggests that the EC re-rating may be over, but from here, the future upside depends on earnings growth and not just multiple expansion. The Hang Seng Index has broken above the key 27,000 mark, testing the same zone where it began its slide back in July 2021. After years of underperformance and relentless selling pressure, Hong Kong equities have staged a remarkable comeback, up nearly 80% from the 2022 lows. Renewed optimism around China's policy support, tech earnings, and capital inflows is fueling this rebound. But this, but this is a key test. The 27,000 zone has acted as a major resistance before, and whether this rally continues will depend on sustained investor confidence and Beijing's follow through on stimulus. Years, gold has quietly outperformed most assets, not just in US dollars, but across nearly every major currency. From 2000 to 2025, gold rose over 1,200% in US dollar terms and a staggering 2,640% in Indian rupees, showing its resilience across inflation spikes, monetary shifts, and quite a lot of other things. In 2025, gold is up nearly 47% in US dollars and over 50% in rupees, reinforcing its role as the ultimate debasement hedge in a world of currency volatility. Chart. Personal loans have grown nearly 20% annually, vehicle loans over 13%, and services credit 14% since FY20. Yet, key demand indicators tell a different story. Manufacturing GVA is up just 9%, real consumption is up only 5%, and vehicle sales is up only 3%. This data suggests India's credit boom hasn't fully translated into economic demand. Much of the lending is consumption linked or leverage spending, while exports and manufacturing remain the weak spots. Between 2005 and 2015, services and software exports grew nearly 15 to 17% annually. But in the last decade, the momentum has cooled. Services now grow at just 9%, and private transfers like remittances have also slowed to 7%. India's nominal GDP growth has steadily weakened over the last decade, sliding from around 16% in 2011 to under 10% today. With both domestic and external engines now driven more by stability than speed, a sign of maturity, no doubt, but also of structural headwinds. Foreign investors have turned cautious on India, and the data shows why. The rupee has been depreciating while the dollar has strengthened most of 2025. India's weight in the MSCI Emerging Market Index has slipped from nearly 19.7% in 2024 to just 15.5% in September 2025, a clear sign of reduced global exposure. Meanwhile, the yield spread between Indian and US 10-year bonds has narrowed, cutting any carry appeal. Both FDI have weakened this year. With a firm dollar, moderating growth, and narrowing yield differentials, foreign money is staying on the sidelines, at least for now. India's retail investor base is booming, spreading far beyond Bombay and Delhi. As of February 2025, the stock market has over 9 crore registered investors nationwide. Maharashtra leads with 3.75 crore investors, followed by Uttar Pradesh at 2.35 crores and Gujarat at 1.92 crores. Southern states like Karnataka, Tamil Nadu, and Kerala each have around a crore participants, signaling a deeper retail penetration. Even the smaller regions are joining in. Ladakh, Mizoram, and Northeast together account for over 4 lakh investors.